What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the top 7 food stocks that you should consider buying right now according to this article by Investors Place. So what I'll be doing for you guys today is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analyses to see whether these 7 companies either belong in our dividend portfolio or our value portfolio by using this checklist. So if you guys feel like being amazing and awesome, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it and hope that this video brings you a lot of value in your stock market analysis. Now, without further ado, let's get this video started. So 7 hot food stocks to buy for tasty returns. Investors should gobble up these outperforming stocks with the long term in mind. By stephan, jikh, Investor Place contributor. So several sectors of the economy, such as the food industry, have become increasingly important in our daily lives thanks to the novel CVPD. Especially during the initial lockdowns earlier in the year, billions of people amended their working and shopping habits to reflect the growing stay-at-home trend. While people stockpiled on food items, shares of food companies also caught investors' attention. Due to the revenue growth and improved margins, a number of these stocks have made new 52-week or even all-time highs recently. Therefore, today we'll discuss 7 hot food stocks that may deserve your attention. Recent research emphasizes that a dramatic image from the early stages of the pandemic. Empty grocery store shelves was far from unique. Why? According to researcher Jill Hobbs, the food retailing sector is dominated by grocery chains. Spikes in demand brought about by stay-at-home orders made it hard to keep shelves stocked. Plus, with many restaurants, cafes, bars, and hotels closed, grocery stores had to pull more weight than usual. A wide range of companies operate in the food chain, each playing a different yet a vital role in feeding 7 billion people across the globe. Farms, grocery stores, delivery firms all have helped address the growing demand and changing consumption trends. These companies are all hot. So here are 7 food stocks to buy now. So these are the 7 companies that are mentioned here. Let's have a look at the first one. Is Amazon, ticker symbol AMZN. As a great deal of buying has shifted online, Amazon, the largest US e-commerce retailer, has become even more vital. In recent quarters, the company has been expanding its e-commerce and physical retail operations as well as one-day delivery services for Prime members. Amazon's food delivery service, Amazon Fresh, has also become an all-encompassing grocery hub. Prior to the pandemic, Amazon had made Seattle the home to Amazon's first full-size cashier-less grocery store, Amazon Grocery. The store has about 5,000 items, including fresh produce, meats, and alcohol. In June 2017, the company also acquired Whole Foods for $14 billion. Amazon reported Q2 earnings in late July and smashed through the Wall Street expectations. Revenue increased by 40% to $88.9 billion. Net income was $5.2 billion and earnings per share were $10.30. A year ago, the respective numbers were net of $2.6 billion and the EPS of $5.22. So, the Amazon stock price reflects the group's success in serving consumers both in the US and abroad. Shares started the year at $1,875. The 52-week range includes a low of $1,626.03 in mid-March and a recent high of $3,495. Both fundamental metrics and price momentum of late have been on Amazon's side. I would regard any price dip in Amazon stock, especially towards the $3,250 level, as a buying opportunity for long-term shareholders. Okay, now let's have a look at Amazon stock, ticker symbol AMZN. So when coming to the price to earnings multiple, we can see that Amazon is currently trading at 134 PE ratio, while the S&P 500 index is around 30.22. In terms of the price to earnings ratio, definitely it is on the overvalued side, and I believe that the investors are willing to pay a large amount of a price when compared to the earnings due to its growth potential that the company has to offer, right? So in order for a company to meet or be a part of my dividend portfolio, it needs to meet 4 rules that are derived from these books, and these are my interpretations of the book's findings, right? So the first book is Dividends Still Don't Lie by Kelly Wright. They run their own IQ Trends platform, a highly recommended website to check out, which is purely based on dividend investing. And the second book is Get Rich with Dividends, a proven system for earnings by Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters from Morningstar. And the 4 rules are as follows. So the rule number 1, it's a mandatory field, right? So the current free cash flows must be positive. What I mean by this is that we want to be making sure that the company that we're investing in has a positive cash flows coming in, so that you can sleep well at night knowing that your money is working for you. And rule number 2 is that the dividends that are being paid out should not be more than 75% of the current free cash flows. So what do I mean by this? We want to be making sure that at least 25% of the revenue of the free cash flows is being retained into the business. Some businesses are pretty mature and they don't need that much amount of capital in order to run the business, but irrespective of the fact, we need to make sure that the company does have some free cash flows that it can allocate to, just in case if it does run into any troubles in the coming future, right? And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. So we want to be making sure that we're investing in companies that have been growing its dividends year over year for a minimum of 5 years. And if you want to be on the more conservative side, you can consider 10 years for that. And rule number 4 is our buy target, the price range at which we should be considered to buy this particular dividends paying stock. We'll only buy it when the current dividend yield is greater than or equal to the 5 years average of dividend yield. Now let's have a look at it to see if Amazon meets that particular criteria. So I use Y charts because they do a really good representation of the financial data rather than looking at the balance sheets, the cash flow statements and the income statement. So looking at Amazon, we can see that the revenues have been increasing. The free cash flow is positive, but it hasn't paid out any dividends, meaning that the complete free cash flow, which is $21.65 billion, is being reinvested back into the company. So since it does not pay a dividend, we cannot consider it as a dividend paying stock in our portfolio, but we can still see if it meets our value criteria to see if we can buy it in terms of a value perspective, right? And in order for a company to meet my value portfolio, it needs to meet 5 rules this time, right? And these 5 rules are based on these 3 books. The New Buffettology, which is written by Mary Buffett and David Clark. Mary Buffett used to be the daughter-in-law of the Oracle of Omaha, Warren Buffett. And the second book is Rule Number 1, Investing by Phil Town, a really good book to read. And the third book is The Little Book That Still Beats the Market by Joel Greenblatt. And the 5 rules are as follows. So the value, in order for a company to be a part of my value portfolio, rule number 1 is that the return on invested capital needs to be greater than or equal to 10. I put a star over there because I might consider it lesser sometimes, provided that it has a fundamentally strong balance sheet, good cash flows, and the intrinsic value is really good, and we're getting at a really good markdown. Yep. And rule number 2 is that it needs to have consistent net cash flows, which is a mandatory because we want to be investing in companies that have a good cash flows, and we can predict the cash flows to a certain extent 10 years from now. And rule number 3 is that the company needs to have a strong balance sheet. A lot of people generally tend to look at debt to equity ratio, but it doesn't give out the complete picture. So what I like to do here is I like to look at the long-term debt to see how many years it would take the company to clear it off. As a general rule of thumb, I want to be looking for companies that can clear off this long-term debt within 6 years or less than 6 years. The lesser the number, the better. Yep. And rule number 4 and rule number 5 are our buy criteria. So we only want to be entering in the stock when the current price of the stock is at a markdown of at least 20% from its fair price. And rule number 5 is a scenario that we'll look into if rule number 4 isn't met. If the price to earnings multiple is less than the 50% of the highest price to earnings ratio over the past 5 years, and it is cheaper than the S&P 500 index, then we would be considering investing into that company by using rule number 5. Now, let's have a look at Amazon stock right now. As we know that their current return on invested capital is 15.20, which is definitely above 10%, which is a really attractive number to see. So the higher the number, the more profitable the company is, right? So it has been fluctuating a lot, the return on invested capital, but currently 15.20% is pretty good. And the revenues are pretty good. The free cash flows, as we can see, it was around $2.5 billion. Let's see how many times it is doubled, right? So 2.5 double is 5, that's 1 double. 5 double is 10, that's 2 double. 10 double is 20, that is 3 times double. So on an average, year over year, Amazon has been increasing its free cash flows at a rate of 30% on a compounding annual basis, right? So consistent net cash flows, definitely. Now let's look at the balance sheet aspect of it. So on its balance sheet, which was released in the recent quarter, it has $33 billion in long-term debt. What this means is that this long-term debt is the amount of financial obligations that it owes to third parties. And we can look at the total current assets, which is $110 billion or $111 billion approximately. So these are the assets that can be liquidated or converted into liquid cash within a span of 12 months or less. So since it has a nearly $111 billion, it can clear off the long-term debt within the next coming 12 months if the management or the board of directors chooses to do so. So definitely a strong balance sheet. Now let's calculate the intrinsic value of the company, right? So the earnings per share diluted is $26.01. Now let's see at what range the price to earnings multiple was trading over the past 5 years for Amazon. So 70.68, that's the lowest, and the highest is 1005.75, which is just a bananas number. And now let's look at Amazon, AMZN, and the Wall Street analysts are expecting that the company to grow at nearly 36.03%. All right. Now what we're doing here is, or what this spreadsheet is doing, is it's taking the earnings per share and multiplying it with this growth year over year, and till the 10 years, we'll get X as the earnings per share, right? Then we need to make sure that we're multiplying that earnings with the proper price to earnings multiple that we think that Amazon might be worth. So a good thumb rule is that you can either implement the price to earnings ratio that it has been trading over the past 5 years so that we can get a vibe for the price to earnings ratio, or you can consider the analyst estimates and multiply it by 2, right? So a good rule of thumb is to always consider the minimum one of these two, which is 72.06 or 538.22. So we'll be considering 72.06 because we want to be on the conservative side. Just say, for example, if it does happen to trade at an earnings per share of 538.22, then hey, we would have the price appreciated to really good levels, and that would be really beneficial for us. But at least to be on the conservative side, let's consider the minimum one. So based on these values, we can see that the company stock might be worth somewhere around $29,000 10 years from now. And considering the fair price of, we're bringing it back to present day, and we're considering a minimum annualized compounding growth rate that we expect from our company or our investment at a 15%, we should be buying the stock when the company is at $8,497. This is known as sticker price. That's what Full Town calls it. And we want to be never paying the sticker price. We always want to be getting a discount on this so that we can account for all the future vicissitudes. So we don't know how the future entail, and maybe the earnings might drop for Amazon in the coming 10 years that we can project or the analysts can't foresee right now. So as a result, we'll be considering the margin of safety of at least a 50%. That is the ideal amount that we want to be considering. But if it is a really good blue chip stock, you can consider at a 20% markdown from here, so that at least we're buying it at a 20% discount from the retail price or something like that. Yeah. So looking at this, we can see that Amazon is trading at around $499 per share at the time of this recording. And looking at that, it is definitely on more than a 50% markdown, because we should be considered buying the stock when it's $4,248. Looking at the current valuations, Amazon is definitely a buy based on the value proposition that it brings through to us. Okay. Value portfolio as it meets rule number 4. Now let's have a look at the next company in this list. The next company in this list is Beyond Meat, ticker symbol BYND. So Beyond Meat prides itself for bringing a plant-based meat alternative to consumers. Beyond Meat stock also gets a long of short-term trading attention. It is currently the only public traded pure play in plant-based food. Earlier in August, the California headquartered company released a lukewarm second quarter earnings. Its revenue topped the average estimate. However, revenues at the company's food service business declined close to 60% year over year due to restaurant and fast food closures during the pandemic. Analysts are wondering if the lockdown may continue to affect the company's growth story. After all, plant-based food constitutes a tiny fraction of the food consumed stateside and globally. Yet investors are hopeful that the company will report stronger metrics in the coming quarters. Meanwhile, Beyond Meat has been increasing its partnerships with various well-known brands, including Dunkin' brands, McDonald's, Starbucks, Yum brands, names that investor place readers would be familiar with. These companies have an impressive distribution reach that will likely support the Beyond stock price in the future. In June, shares went over $160, reached to new highs of 2020. Year to date, Beyond Meat stock is up about 80%. Beyond Meat is a young company and there are likely to be hiccups along the way. With this in mind, I see Beyond Meat remaining a hot food stock for the rest of the year. Okay, that's pretty good. Now let's have a look and see what the price to earnings multiple for Beyond Meat is. So currently the price to earnings ratio is non-existent because it doesn't produce a positive earning at all. Now, irrespective of the fact, we are looking for free cash flows rather than net income, because free cash flows give a really good representation of the amount of cash that is indeed coming into the company. So if you were to look at Beyond Meat, we can see that the free cash flows is negative. As a result, we wouldn't be considering it either for our dividend portfolio or our value portfolio, because here we're not here to speculate. We call it as it is, and we will be considering it based on the checklist, right? And now, since this doesn't meet the criteria, let's have a look at the third company in this list. It is Domino's Pizza, ticker symbol DPZ. Headquartered in Ann Arbor, Michigan, Domino's Pizza is the largest pizza company in the world based on global retail sales. It is also among the top food stocks that have been benefited from customer cravings in 2020. Currently, there are more than 17,100 stores, including more than 10,000 outside the US. The chain has about 770 independent franchise owners in the United States, with more than 94% of Domino's stores stateside franchise owned. On July 16th, the group announced second quarter results. Global retail sales, which were positively impacted by US same-store sales, increased 5.7%. US and international same-store sales increased by 16.1 and 1.3% respectively, compared with the same period in the previous year. The business generated $119 million in net income through the first half of the year, a roughly 13% increase over 2019. Plus, Domino's gets more than 65% of its shares in US digitally. Wall Street regards its digital ordering and delivering infrastructure a top asset. During the quarter, Domino's also acquired a non-controlling interest in Dash Brands, a privately held company that is the master franchisee in China. So far in the year, DPZ stock is up more than 42%. Long-term shareholders are delighted to note the growth since 2009, when shares were around $9 per share. Put another way, $1,000 invested in Domino's, that would now have been about $47,000. I expect the company to reward long-term shareholders for the years to come. Okay, pretty bullish, and the math does check out in terms of the compounding annual growth rate if it has been projecting that much growth. Now let's have a look at DPZ. The current price to earnings multiple is 36.41, which is slightly on the expensive side when compared to the broader S&P 500 index. Now let's have a look at DPZZ, Domino's Pizza stock, to see if it does pay out a dividend. Interesting. So the revenues, it has been increasing, and the free cash flows has been increasing as well. Looking at it, we can see that the free cash flows have doubled twice. So 100 double is 200, 200 double is 400 over the past 10 years. So that equates to around 20% growth year over year in terms of its free cash flows, and it does pay out a dividend. So definitely free cash flows are positive. The dividend is $105.72. Let's see how much this equates to. 105 divided by 411, that equates to around 25% of its current free cash flows at the moment, right? So definitely 25%, meaning that the remaining 75% of the free cash flows can be reinvested back into the company, which is a positive sign. And now let's have a look at the dividend growth history for Domino's Pizza. So looking at Seeking Alpha, we can see that Domino's Pizza has been increasing its dividends over the past 7 years at a rate of 21.06%, which is no joke, right? So 21.06% is a really good amount. Just treat it as this. Just assume that you're going to a job, and the company that you're working for doing the same amount of work, you're able to get around 21% increase on your income year over year. Similarly, just by owning the stock, you're able to increase your dividend at a compounding annual rate growth rate of 21.06%, which is pretty phenomenal for a stock of this caliber. So definitely it meets the third point in our criteria as well. Now let's have a look at the dividend yield. Okay, DPZ. So we want to be buying this company whenever the current dividend yield is more than the average dividend, 5-year average dividend yield. So currently we can see that the current dividend yield is 0.70 and the average dividend yield is 0.89. As a result, it does seem to be on the expensive side, and it's not a fit for our portfolio yet. We can create a tracker that alerts us whenever the dividend yield reaches more than the 5-year average. Let me know if you guys are interested. I might make a video on that, right? So as a result, we wouldn't be considering buying Domino's Pizza stock, but just for fun, let's have a look at when it peaked, right? So in March of this year, at the peak of the CVPD, we can see that it was around 0.91% dividend. So March, if you were to look at that, the current valuation in March, April, August, where's March? The price was somewhere around $300. So it nearly got a 33% jump or a hike within the fraction of 3 to 4 months, which is pretty phenomenal if you had decided to buy Domino's Pizza at that particular time. And I believe that it is a good long-term hold as well. But we missed the opportunity. Nevertheless, we can still see if the company meets our value propositions, right? Now, in order for this, let's hit in Domino's Pizza ticker symbol here. We can see that the return on invested capital is pretty bananas. So it's 69.47%, which is definitely above 10% and not too shabby. And even at the lowest one over the past 10 years, the lowest was 35.64, which is really good coming to a company of this size. We've already analyzed the free cash flows. It has been growing at a rate of 20% year over year in terms of its free cash flow growth, right? Over the long term, if you were to look at it. So the consistent free cash flow is definitely a yes. Now let's look at the long-term debt aspect of it. We can see that it has around $4.1 billion and its total current assets is around $1 billion. So it'll be left with $3.1 billion that it needs to pay out. 3.1 divided by, let's say, 0.3. So it would take around 10 years for the company to pay off its long-term debt. But in terms of the profitability and everything, I know that my thumb rule is 6 years or less than 6. It doesn't meet the criteria of a strong balance sheet. But let's just move forward and see if it is at a markdown price with its current valuations. So similarly to that, we'll be looking at the earnings per share, which is 10.58, $10.58. DPZ. We can see that the price to earnings ratio is 24.83, 46.77. And the analysts are estimating that the company could grow at 26%. So over the past 10 years, we can see that the company had grew somewhere around a range of 20%. That is good. And the future is projected to increase around 15%. So our estimate, we should be looking for the most conservative one, price to earnings ratio, so 30.52. And the intrinsic value of the company is around $1,200, fair price $330, and the price that we should be consider buying the stock is at around $263. As a result, we can look at the current price of Domino's Pizza is $408.76. As a result, I wouldn't be considered buying this company because it does seem to be slightly overvalued at the moment. Okay. Now, let's have a look at the next company, which is Invesco Dynamic Foods and Beverages ETF, which is an exchange traded fund. The expense ratio is 0.65% per year or $65 on a $10,000 investment. Invesco Dynamic Food and Beverages ETF tracks dynamic food and beverages in the Intellidex index. PBJ includes currently 30 holdings. The most important sector by weighting are packaged foods and meats, restaurant, food retail, stock drinks, and agriculture products, which total comprise 85% of the fund. The top 10 holdings make approximately 48% of the net assets. PBJ's top companies include Chipotle, Kraft Heinz, PepsiCo, General Mills, Mondelez. Investors will note that the fund concentrates on food retailers and restaurants while underweighing beverage stocks. The fund's 52-week range has been between $24.44 and $35.79. If you want to add some spice to your portfolio, then you may want to research PBJ further. So PBJ, it's basically a collection or a group of companies that are diversified. So it gives you a good diversification, but we cannot do an analysis based on this particular checklist for ETF funds. The downside of this checklist is that it is only applicable for companies, individual companies, where we can get the financial statements for each and every single aspect of the business, right? Now, the next company is Food Stocks iShares MSCI Global Agriculture Producers. It's also an ETF, but I do want to see what the writer says. but we won't be doing any spreadsheet calculations for this one. So the iShares MSCI Global Agriculture Producers ETF seeks to produce investment results that correspond to the performance of MSCI ACWI Select Agriculture Producers Investable Market Index. This benchmark measures the combined performance of companies primarily engaged in agriculture. VEGI includes 137 stocks, which is more than the previous ETF that we just discussed about. The top 10 holdings make about 52.5% of the fund's total net assets, which are $25.9 million. Its top 5 companies are Dairy, Archer Daniel Midlands, Nutrien, Corteva, and the Japan-based Kubota. The 52-week range for the ETF has been $18.38 to $29.11. Its current price and dividend yield are $28.73 and 2.67%, respectively. Agriculture and food are extremely important parts of our economy. According to the U.S. Department of Agriculture, food, and related industries contribute over 5% of the country's gross domestic product. There will likely be a lot of growth opportunities in the agriculture space, and the stocks in the sector as well as VEGI may see new highs in the coming quarters. So they're mostly invested into agriculture producers or agriculture products. Now the next company on this list is iShares Global Consumer Staples ETF, ticker symbol KXI. The expense ratio is 0.46% per year. The iShares Global Consumer Staples ETF allocates nearly 53% of its weight to U.S. consumer staple funds. Businesses based in 10 other countries, including the United Kingdom, Switzerland, and Japan, are also a part of the fund. KXI, which has 92 holdings, follows the S&P Global 1200 Consumer Staple Sector Capped Index. Broadly, it gives consumers access to essential products like food and household goods. The fund's top 5 companies are Nestle, Procter & Gamble, Walmart, PepsiCo, and Coca-Cola. Other non-US companies investor place readers would be familiar with include US-based drinks manufacturer Diageo, French cosmetics and fashion company L'Oreal, and Dutch household goods producer Unilever. Overall, I find the global consumer staple sector to be well suited for investing in the days of the novel CVPD. Okay, now let's have a look at the last company in this list, I believe, which is McDonald's, ticker symbol MCD. McDonald's, which has one of the strongest brands globally, operating more than 38,000 restaurants in over 100 countries. Its largest segment is the United States. About 90% of the restaurants are currently franchised, as these franchisees carry the operating costs and the business risks. McDonald's does not have to worry about the expenses of running other operations. Even more importantly, it collects rent from the franchisees. It leases those out to the franchisees, often at significant markups. It may not be wrong to say that McDonald's is in the real estate business as much as food service. As a result of the pandemic, McDonald's has started providing pickup, curbside, and even delivery options for diners. Will this work long term? Hopefully. So far in the year, McDonald's shares are up about 8%. The rest of the year may bring more uncertainties for consumers, but recent research by Sandeep Dutta and Vignesh Prabhu of Clemson University highlights that a franchised company like McDonald's shows resilience and holds the stock price steady even in average market meltdown. Therefore, long-term investors may regard the dips in McDonald's shares as opportunities to buy a hot food stock on sale. Now let's have a look at McDonald's price to earnings multiple when compared to the rest of the wider or broader market. So it's 33.63, slightly expensive when compared to the S&P 500 index. So MCD. So the revenues have been falling, which is not a positive sign over the past 10 years, but the free cash flows have been increasing. Not that significant. It would be around maybe 1 to 2% growth year over year on a 10-year time frame. So the cash flows are positive at the moment. And let's see how much the dividends equate to. 3.582 divided by 5.728. So it accounts to around 62% of the free cash flows, which is being paid out as a dividend. Okay. So it definitely meets the criteria that it's not more than 75% of the free cash flows currently. And let's see how long McDonald's has been increasing its dividends. According to Seeking Alpha, it has been paying out dividends since 1990, but it has only been increasing its dividends over the past 11 years at a rate of somewhere around 8.72%. Not too shabby, definitely meets the third rule in our criteria. Now let's see if it is the right time to buy the McDonald's stock. So ticker symbol MCD, we can see that the current price to earnings, the dividend yield is 2.36, which is definitely lesser than the average 5-year dividend yield, and it is on the expensive side. As a result, we wouldn't be buying the stock. But just for fun, let's have a look at when there was a spike in the dividend yield. It was around March of this year, which was trading around 3.25%. And if you were to look at McDonald's stock price at that particular time frame in March, we can see that the stock was trading around somewhere around $150 per share. Yep. And it nearly got a $50 hike, so nearly a 33% in a fraction of 3 to 4 months. That is what happens to these sort of dividend stocks, guys. Whenever they're undervalued, a lot of companies or like a lot of retail investors or so, they come and buy it over here and lift up the stock price considerably. Now, because it's being on the expensive side, it can be a part of our dividend portfolio, but we can definitely see if it can belong in a part of our value portfolio. Okay, McDonald's Corporations, just hide Domino's Pizza there. So 23.73, which is pretty good. The net consistent cash flows, yes. Strong balance sheet. So it currently has $38 billion in long-term debt, which it can cover partially. So 38 minus 6, around $32 billion, even if it liquidates its current assets, right? So $32 billion will be the amount of long-term debt that it will still have in its balance sheet. And 5.72 minus 3.582. So around $2 billion it's able to retain. So 32 divided by 2 means that it will take the company somewhere around 16 years in order to clear the long-term debt with its current free cash flows. That is a significant amount of number. As a result, I wouldn't be looking to consider that as a part of our value portfolio, right? So closing remarks for this article. So on the date of publication, Tizian Jeksil did not hold either directly or indirectly any position in the securities mentioned in this article. Tizian Jeksil has worked in investment management for over 2 decades in the United States and UK, in addition to formal higher education, including a PhD degree in the field. She has also completed all 3 levels of Chartered Market Technician examination. Her passion is for options trading based on technical analysis of fundamentally strong companies. She especially enjoys setting up weekly covered calls for income generation. She also publishes educational articles on long-term investing. So I had a really good read of the article. Unfortunately, it's only one company that meets our particular checklist, which is Amazon. And not in terms of a dividend perspective, but in terms of a value proposition, it is at a 50% markdown, right? So if you guys are keen on interesting in Amazon, you can do your little bit of more research on it before investing into the company, right? So if you guys have stayed around till this part of the video, I really appreciate it, guys. I don't take this for granted. And full disclosure, this video is for educational and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques and ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So if you guys feel like being amazing, make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos. And until next time, catch you in the next video. Peace.